The crisis that started before most people noticed. On January 28, 2021, millions of people believed they were participating in a revolution. For a brief moment, it appeared that ordinary investors had discovered a weakness inside the financial system. A struggling video game retailer called GameStop had become the most talked-about stock in the world. Retail traders were celebrating. Hedge funds were losing billions. Financial news dominated every screen. The story felt simple. Small investors versus Wall Street. David versus Goliath. Then something strange happened. Trading restrictions appeared. Certain brokerages limited purchases. Confusion spread. Anger followed. Millions of people began asking the same question. Who actually controls the market? Many blamed brokerages. Others blamed hedge funds. Some blamed regulators. But buried beneath the headlines was an institution most people had never heard of. An institution so important that modern markets cannot function without it. The Depository Trust Clearing Corporation. The DTCC. If you've never heard of it, you're not alone. Most investors haven't either. And that is precisely what makes this story so interesting. Because while financial media focuses on billionaires, stock prices, and market crashes, an entirely different layer of the economy operates quietly beneath the surface. A layer responsible for recording ownership. A layer responsible for settling trades. A layer responsible for ensuring trillions of dollars move where they are supposed to move. The DTCC rarely appears in headlines. Its executives are not celebrities. It does not ring the opening bell at the stock exchange. Yet every day it helps process transactions measured not in millions, not in billions, but in trillions of dollars. To understand why that matters, imagine buying a house. You provide payment, the seller transfers ownership, the transaction is recorded, the process feels complete. Now imagine that same process occurring millions of times every day across the financial system. Stocks, bonds, mutual funds, retirement accounts, pension funds, exchange-traded funds. Without a trusted mechanism recording and verifying ownership, chaos would emerge almost immediately. This is the role institutions like the DTCC perform. They are part of the invisible infrastructure beneath the visible market. Most people believe markets are simply places where buyers and sellers meet. That is partially true. But it leaves out the most important part. What happens after the trade? The average investor never asks this question because technology makes everything appear instant. You tap a button, the shares appear, your balance changes, the transaction appears complete, but appearances can be misleading. For decades, stock transactions did not settle instantly. Even today, settlement remains a process rather than a moment. Ownership must be verified, cash must move, records must be updated, obligations must be fulfilled. Someone must ensure both sides honor their commitments. This process is called clearing and settlement. It sounds boring. Most important systems do. Electrical grids sound boring. Water treatment facilities sound boring. Internet infrastructure sounds boring. Until something goes wrong. Then suddenly everyone pays attention. The GameStop event became one of those moments. A brief period where millions of people accidentally saw the plumbing beneath the system. For years, investing had become increasingly easy. Brokerage apps reduced friction. Commissions disappeared. Opening an account took minutes. Financial participation felt more accessible than ever before. Then, GameStop exploded. The company had been heavily shorted by institutional investors. Large funds believed the stock would continue declining. Billions of dollars were wagered on that assumption. Then a growing online community began buying shares. More buyers arrived. Prices climbed. Short sellers experienced losses. Those losses forced additional buying. That buying pushed prices even higher. The cycle began feeding itself. Within weeks, GameStop became a global phenomenon. People who had never purchased a stock suddenly opened brokerage accounts. Social media transformed investing into a cultural event. For a brief moment, it appeared as though traditional market power had been disrupted. Then, restrictions appeared. The explanation frustrated many investors because it felt technical and unsatisfying. But technical explanations are often where the real story lives. As volatility increased, risk increased. As risk increased, collateral requirements increased. And as collateral requirements increased, pressure spread throughout the infrastructure supporting the market. This is one of the least understood realities of finance. Markets are not simply collections of prices. They are networks of obligations. Every transaction creates commitments. Every commitment creates risk. Every risk requires someone willing to absorb it. The higher the volatility, the more expensive that responsibility becomes. Most investors never see these layers. They see prices. Systems see obligations. They see gains and losses. Systems see exposure. They see charts. Systems see risk. The invisible economy often operates this way. Visible outcomes attract attention. Invisible mechanisms determine what is possible. The DTCC exists because trust alone cannot support a modern financial system. Scale requires infrastructure, verification, record-keeping, settlement, risk management. Without those functions, markets would struggle to survive. This creates a fascinating paradox. The most important institutions are often the least visible. People recognize major brands. They recognize stock tickers. They recognize billionaires. Yet the infrastructure quietly coordinating trillions of dollars remains largely unknown. The same pattern appears throughout society. Most people think about cars. Few think about roads. Most people think about websites. Few think about servers. Most people think about transactions. Few think about settlement. Invisible systems often matter more than visible participants. This is one of the central ideas behind the invisible economy. The structures shaping outcomes frequently exist beneath public awareness, and because they remain hidden, they are rarely questioned. The GameStop event was not simply a battle between retail investors and hedge funds. It was a reminder that every market depends on layers most participants never see. A reminder that infrastructure matters. A reminder that visible activity depends upon invisible coordination. When pressure enters a system, hidden architecture becomes visible. Bridges reveal their weaknesses under weight. Electrical grids reveal weaknesses during storms. Financial systems reveal weaknesses during volatility. Stress exposes design. The more pressure a system experiences, the easier it becomes to see how it actually works. This is why events like GameStop matter, not because of the stock itself, but because they reveal structure. For a brief moment, millions of people discovered that markets were more complicated than they appeared, not necessarily corrupt, not necessarily unfair, but layered, deeply layered. Every visible market sits on top of invisible systems. Systems of collateral, systems of liquidity, systems of settlement, systems of trust. These systems rarely receive attention when everything is functioning normally, but they determine the boundaries within which everyone operates. And that realization leads to a larger question. How many other invisible systems shape our daily lives without our awareness? Payment systems, credit systems, mortgage systems, insurance systems, retirement systems. Each one quietly influences behavior. Each one shapes opportunity. Each one establishes constraints. Yet most people only encounter them through outcomes. The invisible economy is not hidden because someone intentionally concealed it. In many cases, it is hidden because complexity naturally fades into the background. People focus on results. Systems focus on process. People focus on events. Systems focus on flow. People focus on headlines. Systems focus on obligations. The DTCC is only one example, but it reveals a broader truth. The economy most people experience is not the economy making decisions. It is the economy reflecting decisions already made. Behind every transaction exists a process. Behind every process exists a system. And behind every system exists a structure most people never see. The next time a market moves unexpectedly, the most important question may not be why the price changed. The most important question may be, what invisible system just revealed itself? Because that is often where the real story begins.